We actually think that we could see a hawkish pivot from the Fed this year because you've got strong growth. You do have strong productivity. AI could be deflationary, but we think AI is inflationary, not deflationary in the short term. And that's because you're creating a competition between the biggest companies in the world that are contesting finite resources, chips, memory cards, the inputs into data centers. That's creating inflation in those inputs in some commodities and also some consumer prices. And if you account for the fact that the Fed has to deal with an economy which has the weakest population growth in history, so the Republic has the slowest population growth because Trump's also been incredibly successful at cauterizing the borders. So illegal crossings have slumped by 95%. And this means we've got no labor supply in the US. So if you've got a booming US economy with no labor supply, you could get wage inflation. So if we get a re-rating of rates, then we have seen rates rise, obviously in Australia. If we, heaven forbid, got the Fed talking about having to hike rates, and we've been saying this for 6 or 12 months, and actually just in the last 24 hours, Fed voters have come out and said, well, we actually think the next move may be up, not down. That could be a big problem for asset prices because if you get a US 10-year bond yield that starts moving back towards 5%, watch out equities.